Hey everyone, with the rise of social media, one thing I've observed is that sentiments are playing an important role in stock investment. Whether it is good news or bad news, it instantly gets spread among millions of people via WhatsApp, Twitter, YouTube, Instagram, Telegram, and various other platforms. Now, strangely, I've come across multiple examples where the stock became too hated over social media and people started making fun out of it, and that's when it made the bottom. Basically, when a company enters a rough patch, maybe margin dip, demand slow, or a competitor making noise, the crowd instantly shift to negativity. Meme starts, narrative spread, and suddenly nobody wants to own that stock. The price keeps falling, not because the business is broken, but because sentiment is broken. That's exactly where the opportunity lies. On the contrary, when everyone over social media loves the stock, it really outperforms. This is the foundation of Contra Investing. Going against the wind, looking where nobody is looking, and buying when the crowd has given up. It sounds simple, but emotionally it is extremely difficult. Because going against the crowd feels uncomfortable. But historically, this uncomfortable zone is where the wealth is created. So today we'll discuss 5 such case studies where company delivered massive return when the market rejected them. Then we'll understand why hated stocks often outperform. Then we'll look at 2 key risks of contra investing, and finally we'll look at some of the sectors or themes that are rejected today that can potentially outperform. Alright, let's get started. Let's start with the first case study of Laurus Lab. Now, Laurus Lab was one of the star of COVID bull run. Before COVID, it had only 45,000 shareholders, and then during 21-22 phase, its revenue and profits exploded. That resulted in exponential growth in its share price. During that phase, its shareholder jumped by more than 10 times. However, after 2021, Laurus Lab went through a brutal phase. Its revenue growth slowed down, margin collapsed, and net profits tanked. As a result, its share price tanked around 60%. During that phase, people started calling it bogus lab, and its shareholders started reducing every single year. However, the stock price bottomed out in April 23, and since then the stock has generated more than 3 times return. Now here, you can't build conviction if you don't understand what is really happening behind the scene. In case of Laurus Lab, its ARV segment was struggling, but company was investing heavily in non-ARV segment. Plus, CDMO opportunities were expanding. And most important, it was the leadership of Mr. Chava who always led from the front. Those who kept patience and conviction during the difficult phase got rewarded. Then second case study is of Zomato. During its IPO, Zomato was one of the most talked about company on social media, and that got reflected in its share price that zoomed from IPO price of 70 rupee to 160 rupee in no time. But then it crashed like there's no tomorrow from 160 to 40 rupee. During that phase, Zomato became the internet's favorite punching bag. People started comparing it with tomatoes. But what Zomato did surprised everyone. It acquired Blinkit to lead the quick commerce segment that became its massive growth engine. As a result, its TAM expanded and growth exploded. Eventually, its share price zoomed 7.5 times from the lows. Then third case study is of Asian Paints. When Grasim announced Birla Opus, the entire internet wrote off Asian Paints. They said, monopoly gone, game over, or worst stock to own right now. People forget that Asian Paint has decades of execution excellence, a superior supply chain, and deep distribution that takes years, not months to replicate. The stock fell sharply, but Asian Paint has quietly rebounded brilliantly in last 6 months. Fourth case study is Divis Lab. Similar to Laurus Lab, Divis Lab revenue and profit also zoomed during COVID phase, and that got reflected in its share price. As a result, its number of shareholders also jumped multiple times. However, post-COVID boom, company's revenue and profit degrown, and share price tanked badly. As a result, the number of shareholders started reducing. But company again made a strong comeback, and its stock price is up by more than 2 times from the lows, rewarding the one who kept conviction on the company or those who utilized the correction phase to accumulate the shares of the company. Then fifth case study is of Dr. Lal PathLab. Again, during COVID, company's revenue and profit exploded. That resulted in huge increase in share price. Retail investors rushed in to buy the shares, and that resulted in massive increase in number of shareholders. However, post-COVID, when things normalized, margin fell down, and that impacted the profit in 23. As a result, its stock price fell down significantly, and then weekends started exiting. Meanwhile, the growth came back and share price has significantly recovered from the lows. Likewise, there are many more examples. Look at Nykaa. There was a massive hype during its IPO that attracted more than 3 lakh shareholders that kept on increasing till 5.77 lakh. And that's when company made its bottom in April 23. Since then, number of shareholders are reducing, institutional holding is increasing, and share price is going up. I can cover many more names, but I hope you got my point. The big question here is, why do hated stocks outperform? Let's have a look. So there are 4 core reasons why hated stocks eventually outperform. First is, fear creates mispricing. When people overreact to negative news, stock price fall more than fundamentals. Second reason is, valuations turns attractive. When nobody wants a stock, valuation becomes extremely reasonable. Third reason is, expectation reset. High expectation kill returns. Low expectation create upside surprise. And the fourth reason is, the cycle turn and sentiment flips. Every business goes through phases. A temporary slowdown often set up the next growth cycle. So here is the golden rule of Contra Investing. When great companies go through bad phases, that's not a threat, that's an opportunity. You don't buy when everyone is excited. You buy when everyone has given up. But here is the most important part. Contra Investing is not about buying every fallen stock. It's about separating the wheat from the chaff. And a lot of investors make the mistake of averaging down fundamentally weak companies. That's a massive risk. Let's discuss it in detail. So first thing you need to understand is, not every correction is a contra bet. Some companies fall because of temporary challenges, they are opportunities. But some fall because the business is weak, governance is questionable, or numbers cannot be trusted. These are traps. A great example is Yes Bank. During 2017, when Yes Bank was at the peak of its growth, it had 1.8 lakh shareholders. And when the corporate governance issue popped out, Yes Bank share price started tanking. But retail investors kept on increasing stake in the company. By the time Yes Bank share price tanked 95%, its shareholder count jumped more than 10 times to 20 lakh shareholders. Then recent example is Gensol Engineering, a company that looked exciting on paper, EV solution, solar EPC, growth narratives. But when allegation emerged about the forged bank statement, fake invoices, inflated revenues, followed by resignation and audit concern, the market realized this wasn't a temporary slowdown. This was a broken story. Yet, look at the number of shareholders that are increasing in the company. Then another example is Brightcom Group. When SEBI exposed accounting irregularity, fake subsidiaries and undisclosed liability, the stock fell more than 90%. Not because sentiment was negative, but because the business was fundamentally compromised. But look at the shareholders. Just when the share price tanked, its shareholders jumped 4 times and kept on increasing. Likewise, there are many examples like PC Jeweler, DHFL, Reliance Capital that fell down for structural reasons like excessive debt, fraud, or flawed business model and never came back. But unfortunately, many retail investors end up buying such companies thinking that they can make multi-bagger returns. This is why Contra Investing starts with elimination. You eliminate companies with governance issue, you eliminate companies where balance sheets are weak, you eliminate companies where numbers don't match reality. Only then you can identify the genuinely strong companies that are temporarily facing challenges. Contra investing is not buying what is down. It is buying what is down but not broken. And there is another major risk investors often overlook: the patience trap. Even when your thesis is right and the business is fundamentally strong, contra bets can take an unexpectedly long time to play out. A stock can stay sideways or weak for quarters, sometimes even years, before sentiment finally turns. The market does not reward conviction immediately. If you expect quick returns, contra investing can actually drain you mentally. For instance, Lotus Lab made its high in August 21 and then it kept on correcting till March 23. That's 17 months of correction. And there are many great companies out there that are struggling and still testing patience of investors for years. So you need the temperament to sit through long period of underperformance before the recovery becomes visible. This time lag is exactly why most investors fail to benefit. Not because the thesis was wrong, but because they could not hold long enough. So remember that contra investing works only when the business is fundamentally strong, the long-term demand story is intact, and problem is temporary, not permanent. The real contrarian approach is you understand the core business, check if the long-term demand story is intact, verify that management quality is strong, ensure balance sheet is healthy, and look for valuation reset, not business deterioration, and confirm that company can bounce back once the cycle turns. Only when these boxes are ticked should you go against the crowd. Always remember, contra investing is not about buying what is down. It's buying what is down but not broken. And that is how real long-term wealth is created. Now I know what your next question would be. You must be thinking, we have covered some great case studies, but can we apply the same logic today? What are some examples that are struggling today and can be a contra bet? Let's have a look. I think one sector where I see a lot of potential but it is still struggling a lot is chemical sector. Look at Deepak Nitrite. Company had a massive run post-COVID and topped out in October 21. It tanked badly but still recovered. However, since August 21 high, there has been a massive correction and overall the stock is down significantly from October 21 high. Interestingly, number of shareholders in Deepak Nitrite that zoomed 10 times during COVID phase have been reducing since March 23 high. And DIs have increased their stake big time. Yes, the pain may continue for some time, but Deepak Nitrite is doing massive capex. That should eventually reward the company. I've recently done a video on specialty chemical company that can benefit from battery storage boom in India, where some of them are struggling and have been consolidating and correcting. So that is one video that you should watch if you want to know some interesting chemical names. While Chinese competition is a massive risk for Indian chemical companies, it is also a fact that structural demand for specialty chemical is intact. Global customers are still diversifying away from China, capex cycle continues, balance sheet remains strong, and many companies are moving up the value chain. Then another example I can think of is mid-tier private banks like IDFC First, RBL, or even small finance bank like Equitas. They have seen solid correction and weak hands are consistently reducing stake. Here the fundamentals are improving, but still not at the level where conviction comes easily. Yes, credit growth is solid, asset quality has stabilized, retail books are expanding, and valuations are reasonable. But at the same time, past underwriting mistakes, weaker return ratios, higher cost of fund, and the need to prove consistent profitability still make investors uncomfortable. That's why these banks sit in a grey zone. The story is not broken, but it's not fully proven either. That said, today the valuations of these mid-tier banks are at attractive level due to negative sentiment. And considering the potential upside in consumption, these mid-tier banks and small finance company can potentially do well for next couple of years. Then another example of contra bet can be IT sector. Today there's a lot of negativity around the IT sector. Yes, I understand that global IT spending has slowed, deal ramps up have been delayed and margins were under pressure. But social media became extremely negative. IT is finished, no growth left, AI will kill service companies. But the fact is, India remains the world's largest digital talent hub. Cloud, data, AI, cybersecurity spending will compound for decades. Order pipelines are healthy, valuations have normalized, balance sheets are rock solid, and remember, cash flow of these IT companies remain phenomenal. The sector is not facing structural decline in my opinion, it's facing a temporary cyclical slowdown. So if you look closely at all the examples we discussed, Lotus Lab, Zomato, Asian Paint, Divis Lab, Dr. Lal Path or Nykaa for that matter, the pattern is same. These companies bottomed out when the sentiments were extremely negative. And then they rebounded because the underlying business fundamentals started improving while the market was still deeply negative. That is the real essence of contra investing. It has nothing to do with buying every stock that falls or catching falling knife or trying to predict the exact bottom. It is about identifying that rare situation where sentiment collapses but the business itself remains strong. Because when narrative turns toxic and memes replace research, stock price often disconnect from reality. And it is during such phases that long-term opportunities quietly emerge. However, this is exactly where most retail investors struggle. They don't build conviction from understanding the business. They build conviction from watching the stock price. When the price goes up, they feel confident, even if the fundamentals are stressed. And when the price goes down, they panic, even if the business is fundamentally strong. And this behavior prevents retail investors from benefiting from cycles because they end up buying excitement and selling fear. Long-term wealth, on the other hand, is created by doing the opposite. The real contrarian approach is simple in theory but hard in practice. Focus on the strength of the business, not the mood of the market. Ensure the long-term demand story is intact, management quality is solid, the balance sheet is healthy, and the issue are temporary rather than structural. When these conditions are met, a falling stock price is not a warning sign, it's an invitation. That's why sectors like specialty chemical and IT services look very interesting today. Not because they have corrected, but because the long-term fundamentals remain strong while sentiment is still extremely weak. These disconnects don't last forever. Eventually, performance improves, number recover, and sentiment follows. And by the time the sentiment turns positive again, most of the returns are already made. And private banks can also do well as valuations are attractive and business is improving. So the core message is that contra investing works when you buy what is down but not broken. It works when your conviction comes from research rather than noise. And it works when you understand that sentiment can swing dramatically in the short term, while business fundamentals evolve much more slowly. The wealth is created in the gap between these two. Maybe next time, just search which fundamentally strong company or sector has really bad sentiment over social media. So while it may not be easy to hold your nerve when the stock price is falling, it's still worth keeping some allocation in contra bet. Now tell me in the comments, which company do you think can be a strong contra bet at the moment, where fundamentals are intact and they are going through a rough patch? I'd love to know your feedback. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.